Hey guys, hope everything is going well. You guys know that drill. Smash that like button, subscribe if you haven't, comment down below. All right, so I'm over at Zero Hedge, and I know some people really like Zero Hedge is, tinfoil hat stuff, but they do have some good research that I look at. And it says that oil prices are plunging, curve crashes into contango. So what it means is contango for oil prices, and this is going to be around inflation topic and also rate cuts. So contango means that the front month is less than the second month or months out. So in the futures market, that's what they look at. So if you look at it, December 2022, the oil futures is 80.11. In January 2023, oil is greater than the front month. That's how it usually should be, but it's 80.26. It's in contango. It's technically upward sloping for the first 2 months. And this is what I saw in Zero Hedge. Additionally, the nearest position of US crude futures is now flashing oversupply for the first time in a year. The front month spread between futures for delivery in December and January reflects short-term supply-demand balances traded in shallow contango, the industry term for bearish market structure, on Friday ahead of December contracts expiry. So that's interesting. Well, you haven't seen this in a while. So if oil prices go down, you're going to have more money in the pockets of people because they pay less at the pumps. And if this trend continues, that is actually a very bullish sign for the markets. And also, what I find quite interesting, I'm looking at David Brady on Twitter, and this is what he says. This is about the yield curve, so I want to tie it together. Powell's favorite yield curve indicator screaming rate cuts. And in parentheses, he says 180 pivot anyone. As Bloomberg reports in March, Powell touted the 3-month yield out to 18 months as the yield curve with 100% explanatory power. If it's inverted, that means the Fed's going to cut. So, yes, Powell has indicated that there's probably going to be a few more rate hikes, but we're in the environment where that 3-month yield out to 18 months is negative, right? It's what, negative 5 basis points or something like that. When you're looking at that, you're looking at that inversion, that means that number one, we're going to most likely see rate cuts in the next, in my opinion, 6 months. And that will be bullish for the market, right? Whether or not you like rate cuts, I'm trying to figure out how these guys think and what they're going to do, right? It doesn't matter what you want as personal policy. I don't like the Fed, but I have to throw that out the window. I learned my lesson the hard way. I have to see what these guys think like. And if you understand how they think like, you could probably invest better in the future. So looks like rate cuts. In my opinion, this is going to be bullish for bonds. In my opinion, I'm not telling you what to do. This is, in my opinion, going to be bullish for big tech. It's going to be bullish for precious metals. It's going to be bullish for the collectibles industry that I'm in, sports cars, et cetera, et cetera, et cetera. So I'm looking at this, okay, potentially lower oil prices if the contango continues down the road, right? Rate cuts, and I'm seeing that inflation isn't increasing at the rate that it is. You have to look at shelter. That is bullish, in my opinion. And I believe we probably have, like I said, 17, 18 months, whatever, of a good bull market. But once again, those are my opinions. I'm not telling you how to invest. This is just me doing a blog, just expressing my own opinions. But I wanted to hear what you guys have to say, guys. All right, I'll talk to you later.